Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Barbara Doran of BD8 Capital writing, any legitimate threat to the independence of the Fed is to be taken seriously and negatively, as it has the potential to undermine both the dollar and US assets as safe havens for investment. Barbara joins us now for more. Barbara, good morning.
Yeah, good morning.
Let's talk about that first line in that quote. Any legitimate threat. Is this a legitimate threat?
Yeah, that's the question. I mean, in the past, you would think, no, it's not legitimate because it's so obvious the negative ramifications of this. But given the unpredictability we've seen in this president, anything's possible. And if the Supreme Court, we know this, as you mentioned earlier, that the cases before them, if they rule that the president can replace people in these other independent agencies, then I think he might consider it. But if Besson is in there, and Besson does seem to be gaining an influence with the president, hopefully it's not legitimate.
We started this year with a rebalancing towards assets elsewhere. European equities really started to perform. Dollar weakness kicked in. This seems to have taken on a new phase over the last month or so. What do you make of the new leg of this? What's behind it over the past few weeks?
Well, I think with the tariff uncertainty, I mean, we had the pause. You saw what happened with the market. But I think there is a real question about the credibility and legitimacy, of this as a safe haven. As we've seen and everybody's observed, we've had very unusual behavior. As tariffs go up, we really should have the dollar getting stronger as a flight to safety. It's not happening. And in fact, the dollar is down 5% against the euro and the pound, and also 6% against the yen since early April. That's a lot. I mean, as you said earlier, it's been parity just relatively recently, a few months ago. So it's a real question, and it's hard to see that changing because even though we have this 90-day pause, it is just temporary. And so we also are waiting to see what they decide on semis, on pharma, on lumber, on copper, and all sorts of things. So there's no way yet to gauge the impact of these policies. Businesses are still on hold. Consumers are, and every survey that's coming in is showing, sentiment continues to decline. So, we'll see what happens, but it's not good.
Well, this speaks to the macro paralysis that Jim Zelter of Apollo, as John was mentioning earlier, talked about. How do you gauge your longer-term asset allocation at a time where so much has yet to be determined? Have we seen enough to say definitively that you need to diversify away from dollar-denominated assets versus traditional portfolioes of, say, 5 years ago?
Maybe, because the problem here is, the question is always, how much is the market discounting? All right, the NASDAQ is down 15% or plus year to date, S&P down 10%. It's probably discounting a lot, but we don't know the worst case. It seems that the worst case is probably over in terms of the tariffs, but there is no way to judge. So, gold continues to make new highs. I think it will continue because the move toward gold started before this. And that was really in 22 when we froze the assets in Russia and treasuries suddenly like, oh, maybe treasuries aren't the safe haven. And I think this continues it. So the problem with diversifying away, say, to Europe, all the economies, if our worst case tariffs do come in, they're going to be hurt as well. So their growth is going to slow. So I think that for now, you just have to you diversify a bit, and I think a lot of investors are trying to reorient their stock portfolios to more dividend, more high quality, and including gold.
At a time when so many people seem to be whipsawed by sentiment, what's the guiding light? Data is messy. The soft data and the hard data aren't cohering, and we're hearing about the lag time between the two. Earnings are kind of pick your own adventure, throw a dart and figure out what your projection is. Where is this sense of your North Star?
There isn't, I think, because right now all the data that's been coming in, whether it's the CPI, PPI looks good, retail is still good, balance sheets for both consumers and managements are good, but that's looking backwards. And what you're starting to see, earnings season started in earnest, as we know, a couple of weeks ago with the banks. And the banks, again, looking forward, they see no problems as yet, and they're not really increasing the reserves. But a lot of company managers are starting to add, well, we can't really give great guidance. There's this macro uncertainty uncertainty, read tariffs. So it is really hard. I mean, for instance, in our portfolios, we're not selling because in the space of a tweet, the stock market could be up 1,000 points. And that's the real problem here. There is no predictability. But you say, okay, I think the worst is over, so we're holding. If you have cash, there are opportunities at individual stocks coming up. You can selectively take nibbles, but I would not be buying in a wholesale way. There's just no way.
What would make you want to buy?
If we had some certainty in tariffs, which is hard to see right now, we've got 90 days, and if we had more of a process, I mean, as we saw, there's a real question about the methodology when he brought out his famous chart there, and I think there's been a lot of questions about that. If for some reason in the next few months we saw more stability, we had the tariffs that were settled, and we're sure that they were settled, and it was a way to measure the impact, then, and again, depending what that is, if they're too high, even at this 10%, how inflationary are they? The Fed has said they can't act because they don't know, how much is going to impact inflation, how much will growth slow. And you're seeing around the street, every house is taking down their estimates on GDP growth, upping their inflation, but we really don't know how big it will be.
Terry Haynes joined us earlier from Washington. He basically said the market's way too focused on tariffs, Jay Powell's not going anywhere, and that you have to start focusing on tax cuts. This extension of TCJA and maybe another sweetener, is that enough to be excited about year end?
Not for me. I think, they were right to focus on the tariffs. And what the administration, I think, is trying to get us to focus on coming tax cuts, but really, how deep can the cuts be? I mean, we're talking really an extension of the cuts, and there's a give and take going on right now, but I don't see them being draconian. I mean, how can they be? I mean, without exploding the deficit even more. So, and deregulation, I mean, certainly the approval of Capital One taking over Discovery, that's, also will give some investors hope that, deregulation is starting. But that will help on the margin, but I think the tariffs are so important because that affects the entire world.
You touched on something that I've heard quite a few times over the last week. People who are super bearish but aren't selling because they're worried about one positive headline crossing the Bloomberg that leads to some massive upside move on the S&P. And I wonder actually what's going to make people start selling again, because in the meantime, the data seems to be distorted by what we're seeing in a pull forward of purchases by consumers, companies alike, that maybe that data's flattered for the time being. What would it take to start selling again in this equity market?
Well, that is a good question, because I think, what we've seen to date, and it's certainly been true on retail behavior, is buying on weakness, which has not been a good thing. And so I think that once we get some established, presence here, or even any time we have a sudden tweet, they send the market up 1,000, you got to be lightening up. So, and I think that's, like last week, you didn't have time, or 2 weeks ago when it happened, the market was up 1,000, it gave back half of that the next day. So the rapidity of these moves, it's very hard, unless you're a trader or you're algorithmic trader, it's very hard to take action. So, I think, for us, it's just you are in good stocks, you're in good fundamentals, high quality, and you just have to wait out this storm, and storm it is.
Futures right now, down about 1% on the S&P. Barbara, good to see you. As always, thanks for dropping by.
Thank you.
Barbara Doran there of BD8. To extend the conversation, Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme. A lot of bark here. How strong is the potential bite?
I think not that strong, John. Thanks. My summary of this really comes down to about three things. One is that Trump is trying to pass the buck to Powell for whatever market problems exist. Markets aren't going to bite on that, of course. They're very fixed on Trump. Secondly, you got a situation where, as you've been reporting, the Wall Street community is already reacting this time to the possibility of Powell's removal in a way that they haven't before. So that's a real concern. And finally, as Lisa mentioned earlier, you had the folks in Congress on the Sunday shows all basically providing a little bit of subtle pushback. So there's, I think there's at least three reasons why the bark is worse than the bite.
Terry, I'd love to get your thoughts, though, on what Kevin Hassett said, the NEC director, when he said that they're studying that option. He basically left the door open.
Well, I think he should, right? He's a lot of things, but fundamentally he's a staffer. And if he publicly dissents from whatever the president's doing, he's going to be out of there pretty quickly. So, I look at that as a matter of staff loyalty and not much else. They've been studying this since 2018 or 2019, by the way. So I welcome their continued study.
I want to get your thoughts. What I also asked Marvin Lowe, the fact that we're having this discussion out loud, the fact that the president didn't make clear what he said last week, which talking about his termination, is that enough to do damage?
To damage to Trump or to Powell?
To Trump, to the position, as well as to financial markets.
I think it doesn't help financial markets. I certainly don't think it helps the president. I mean, you can parse the statement that you all have been running in the bumpers, and if I want him out of there, he'll be out of there. Well, he's not out of there, and you don't like his policies, so so he's staying. So you must like his policies. So there's that kind of circularity. And number one, and number two, the last thing that Trump needs right now is Wall Street fleeing on him when he's in the middle of the tariff fight, firstly, and secondly, when tax cuts, which are still very, very likely at 80%, haven't come online yet.
It feels like President Trump is playing good cop, bad cop with markets right now. Bad cop, I don't know about Jerome Powell. Good cop, let's make a deal. All of a sudden, all of these deals potentially are on the table with Japan, with EU, and that's the upside that people are looking for. What if this actually leads to some sort of resolution? How much do you expect that to really take the brunt of oxygen this week?
Well, I think this week the White House would be smart to continue to bring out the prospect of deals being done, and I think they were reasonably effective at that the last couple of weeks, and that's all to the good. The better it is for what's best for the White House and what's best for the markets at this point are really the same thing, which are to see progress being made on the tariff deals and to clarify what I always think of as kind of the descent ascendant role here, which is that these things are supposed to be path dependent, and if we do deals, tariff barriers and ex-tariff barriers come down for the United States and for others, benefiting markets. That's all good. By the time you get to next week, what you're going to see is more progress being made on tax cuts with the idea of a third quarter, fourth quarter deal, and hopefully that helps them get through this patch.
Terry, should and will are two very different things, and it seems like you believe that markets do have some sort of, I don't want to say veto power, but certainly weight in the president's mind. What gives you that concrete sense, given the fact that there have been a number of occasions where President Trump has come out and pushed back against caring whatsoever about the move in the markets?
I think it's really this. I was one of the first, maybe the first, to say that I didn't think Trump cared about markets on tariffs with respect to imposing them. Tariffs, in my view, have always been part of a much broader economic plan that includes tax cuts and some other things. They've been, I think, very clear about that. But at the same time, it is not in the president's political interest at all to have markets go seriously wobbly on him at a time where he's trying to impose a lot of those things. So I think that market pressure actually helps define the situation a little bit better politically as well as economically.
Terry, you keep mentioning tax cuts. The market is pricing an extension of TCJA. What cuts are you talking about?
No, I'm talking about the extension of the 2017 cuts, and then you're going to see a bunch of tweaks to that, not just the taxes on tips thing that the president keeps talking about and other things, but I think you're also going to see a restructuring to really favor increased U.S. manufacturing and including reshoring, among other things.
Terry, appreciate your input as always, sir. Thanks for catching up with us this morning. Terry Haynes there of Pangaea Policy. China's Commerce Ministry writing, if such a situation occurs, China will never accept it and will resolutely take reciprocal countermeasures. Leland Miller of the China Beige Book joins us now for more. Leland, welcome to the program, sir. Let's talk about China. The president keeps saying China wants to come to the table and make a deal. Are you seeing any sign that China is willing to come to the table?
Not yet, but I don't think coming to the table is that big a lift for either side. If you read the headlines, it makes it look like the United States is spiraling in one direction, China's spiraling in the other direction. There's just nothing that could bridge the gap. But the real gap right now is these enormously high tariffs. But there's just not that much difference between 145% tariffs and 145,000% tariffs, because you just don't have Chinese goods that are competitive at anywhere near that level. So there is whether it's 145 down to some other level, to 125, 105, 85. These are arbitrary levels. There's nothing economically significant about staying at these levels, which means the president could take these levels down, not be giving up anything of economic substance, but bring the Chinese back to the table. Are they prepared to do that? Maybe not yet, but they have that card in their pocket. And I think that if that was something that the White House dangled, then I think that the Chinese would be receptive to it.
And Leland, once the negotiations begin, what would you anticipate the negotiations would be over?
Well, that is the big question, and that's actually the big question with every trade deal. The talk coming out of a lot of these negotiation rooms is, what in the world does the United States want? Does it simply want to narrow the trade deficit? Does it want some sort of other victories in other lanes? Nobody really knows. I would say that the U.S.-China trade negotiations could go in two different directions. You could have a TikTok, a fentanyl cooperation, and maybe some concessions about Panama Canal, properties, along with some more buying, which is basically phase 1+. That's something the Chinese are probably very interested in coming to the table with if they can get a receptive audience to the U.S. side. If it's more than that, if there are more U.S. asks, this becomes a lot more difficult. Certainly, the United States is not going to be able to tell China to restructure and have that happen. So basically, the administration has to come out with a list of demands, and then the Chinese can see whether they're serious or not. Until that happens, they're talking past each other.
Leland, who has the more leverage at this point, given the fact that some people believe that the U.S. will be disproportionately hurt by some of the export bans or the export restrictions put on by China?
Well, it's tricky because if this were a bilateral spat, the U.S. would have considerably more leverage because of the size of the trade deficit. That doesn't mean that China hasn't worked for years in order to create supply chain choke points, to create other vulnerabilities, in U.S. Supply chains. That's absolutely true. But I think the United States would have more in a one-on-one matchup. The problem is this is going on in the backdrop of huge dislocations around the globe in trade. As tariffs are being weighed, are they going to stay lower? Are they going to be much, much higher? Nobody really knows. So with the uncertainty, it's created another complication for the administration in saying, we're solid here. We're going to force this on you. It just muddies the picture in a way that would not be true if this were a one-on-one battle.
Adding on to the muddied picture, some people are speculating that in the United States, as the government looks to retrench spending and start to really just get its balance sheet in order, China's expanding. And you're going to see the growth on the back end of that, and that you're already starting to see consumer activity picking back up. I know that, Leland, you track this really well in terms of anecdotal and non-government sources in terms of the economic activity. How much is the truth matching the narrative?
Well, you'll be shocked to hear the truth. The truth right now is not matching the narrative. Obviously, Beijing has a reason to look like they have fortified their economy for whatever is to come. And I think to some degree they have prepped the system for being able to do bigger fiscal, et cetera, if they need to do it down the line. But you look at our data and you see consumption. Consumption is very weak. Q1 wasn't a terrible quarter, but March was weak. Consumption was weak. Why were some of the things not worse off? Because you had a sort of rebound in property and you had a rebound in parts of industry. The consumption side of things do not look good. So nothing they're doing on that side is showing a real effect. So I don't think that they're not falling off a cliff. They're not in doomsday yet. But they're certainly not. The consumer is not coming to the rescue right now, and probably in China never will.
Leland, when can we expect a call between President Trump and Xi Jinping?
When the 10 years sends the right signal. I mean, look, to their credit, the administration came into this saying, we're going to do what we want to do on tariffs, and we're not going to be dissuaded by short-term market movements. That's the equities market, and that's true. But the bond market has a much more restraining effect on everyone, and that includes the White House. And so I think what you're going to see is the bond market talking. If it continues to show displeasure, there's going to be increasing pressure on the administration to do something. Not necessarily peel back in a massive way on this or that, but show that they have a game plan, and the game plan is not to abandon the U.S. dollar as a reserve currency. So they have to move towards solidifying something that has hard themes that markets can trust. And to the extent that they need to give concessions with rates at 10% everywhere around the globe except China, that's one place that they may end up moving.
It feels like when you hear from the president or the press secretary, they're saying we're waiting for Xi to call. We're going to be very gracious when the Chinese reach out. Are you saying that if we see a higher 10-year yield, it's going to be the United States trying to get on the phone with Xi Jinping, not the other way around?
I think there's a lot more trying to get on the phone between the two of them than people are talking about. The narrative is always going to be, not us, it was them. And that's going to be that's the story in China. It's going to be the story in the United States. But all they really need to do is put something on the table that looks like that there could be tariff concessions on the U.S. side and that there's a willingness to talk on the Chinese side. I'm not saying that they're there yet, but this is because the rates are arbitrary, as we discussed before. There's nothing that pushes the White House to keep the rates at 145 or 125 or 105 or 85 or any particular amount. That means that there is wiggle room. And I think if you have market pressures, particularly from the bond market, then you're going to have the two sides magically find reasons to come together.
Hey, Leland, good to hear from you. Lena Miller there of China Beige Book. Dawson of NewEdge Wealth saying a lack of Fed independence is a, quote, bad scenario for the US economy and what we call a zoo steepener, both a bull steepener on the short end and a bear steepener on the long end. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
Zoo steepener, I've never heard that before in my life. Where did that come from?
So the idea is that you get both a bull and a bear steepener. It's very much a welcome to the jungle kind of moment because we think it is a bad scenario for the US economy. As you have a bull steeper on the front end, short end yields fall, that hurts cash interest income on money market accounts. Think about those record money market balances that had been generating big, huge cash interest for individuals. Then on the long end of the curve, if you get a bear steepener, the long end moving higher, you don't get the benefit to the mortgage market, you don't get a benefit to corporate finance. So the end result is that you get pinched on both sides with lower yields at the front end and higher yields at the back end.
Do you think this nervousness around Fed independence is a reason to step away from the long end?
It certainly seems that that's how the market is trading. Now, I would note that the 10-year Treasury yield is effectively exactly where it was pre-Liberation Day. So for all of this volatility where we had yields move much lower, then move much higher, we're right back where we started. So if we really do see a de-anchoring of the long end of the yield curve, that would be notable. But at this point, it's just a lot of volatility and a lot of sideways chop.
Given all of the volatility, where are the comforting mantras like don't fight the Fed or, watch the data and data dependency? What's your North Star, as we were talking about earlier in the show?
Yeah, look, it's really difficult. If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders that have been so powerful for U.S. companies and being able to benefit from falling interest rates, from the ability to benefit from rising margins over time. And so the end result is that we're all asking huge, major tectonic shift questions.
Well, okay, so then what do you do with that? I mean, this is sort of the big question, right? Can you follow that, or do you start saying you can't change the world in 10 days? There are going to be some checks and balances and things that will take time, and so you can't throw it away.
I think that diversification is your friend. And if you look at the ability to be able to have a diversified global equity portfolio, I think it's even more powerful today than it was over the last 15 years. You've been in a 15-year relative bear market for non-U.S. stocks. And so you're finally starting to ask the question of, are these non-U.S. companies having a better place and role in a portfolio simply because we're seeing these dynamics of potentially money moving out of the U.S. into the rest of the world.
What does this mean for the U.S. economy writ large, this zoo steepener?
We do think it weighs on growth, and we think that growth estimates are still too high. You're sitting at a level of GDP estimates for 2025 at 1.7%. That's down from 2.3%. That's down from 2024 and 2023 numbers, but it certainly is not to the point where you're pricing in some kind of recession. So we think that also translates to corporate earnings that are likely too high as well. You have 9% growth this year, 13% growth next year, still trading at 19.5 times. This market hasn't fully calibrated to a lower growth world.
Do you think that's because because the market is still waiting on deals to come out of the White House?
100%. There's still a lot of optimism that this could just be a short-term bargaining tactic. But if you actually see these tariffs get applied, we think that growth estimates, again, are just far too high.
We hear so much of this. I saw it from Jonathan Krinsky of BTIG over the weekend. We still get the sense that many assume a tweet about tariffs can erase all the damage that has been done. When do you think we get the wake-up call? Because at the moment, the data is being flattered by a pull forward of purchases. We saw that in retail sales in the last week. When does the wake-up call come? Deeper into summer?
Yeah, we think it actually will take longer. So we do think that hard data is going to soften. Hard data is certainly being flattering by a lot of pull forward. Look at the Dallas activity index. It's having some of its best times since November. You've also seen big upticks in things like autos as well as imports. None of that will last. We think that that will eventually slow, but the challenge you have is that it's going to take time. And that means that the Fed is going to take time because the Fed has been very explicit. They're waiting for hard data to slow in a more meaningful way to take action, which just means that they will be late to the game this time around.
What does the wake-up call look like in equity markets?
We do think that you're in an environment where you can see short-term rallies because positioning has gotten so light. It's incredibly important to note Deutsche Bank consolidated positioning is in the second percentile. So it doesn't get much worse than that. That allows you to lift in the short run, but you are in a downtrend. You have a death cross that happened last week. You have momentum that has faded, which means that you can have these rallies, but they likely roll over. And that will then result in people starting to finally move out of equities and potentially reduce equity positions, which adds to further volatility.
So lower, and potentially a lot lower. This really goes to the ultimate question, and it's kind of where we started, which is how much at that point, if you do see true economic weakening, do bonds attract that cash back?
I think eventually they do, but you have to see yields move higher to draw people back into this market before people see them as a safe haven trade, which just means that bonds don't play the same kind of volatility dampening role in portfolios that they used to. We think once you start seeing hard data weaken, that's when people will step into bonds, but it's one of those moments where it has to get worse before it gets better.
What's playing that role now? Is it just gold for everyone?
Yeah. It certainly seems that way. The one thing we'd note about gold is that it is technically overbought, and you have seen very aggressive inflows into gold, which suggests that you could see a breather, but the uptrend is very, very powerful.
Raises the question, what does diversification mean in 2025 versus years gone by? We hear the D word all the time, diversify, diversify. Into what and away from what? What does that mean now?
Yeah, so it means that you have to get really creative. At the end of last year, we said that we thought equities would be higher volatility and lower return. So we launched an uncorrelated strategy which looked at everything from water rights to litigation finance to infrastructure, things that don't derive their return streams from traditional equity markets or what the Fed is doing. But again, it's creativity. It's not something that is typically in your 60-40 portfolio.
Cameron, appreciate your time. Cameron Dawson of NewEdge Wealth with the so-called Zoo Steepener.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.